Good day and welcome to the Snam 2017 first quarter results conference call. Today's conference is being recorded. At this time, I'd like to turn the conference over to Miss Alexandra Piscini. Please go ahead, ma'am.
Good afternoon, ladies and gentlemen, and welcome to Snam 2017 first quarter results presentation. In the quarter, gas demand was up by 2 BCM, mainly thanks to the thermoelectric and industrial sectors. Our good financial results benefited from the positive contribution from our regulated business, our continued focus on efficiency, capital structure optimization, and a lower corporate tax rate. These results were further enhanced by temporary or seasonal effects, which I will explain later in the presentation. In the quarter, we also executed 201 million euro share buyback. Funding costs were further reduced thanks to the liability management exercise of last year and also to the new issuance of 1.2 billion euro done in the first quarter of this year. The first quarter results provides a solid start and allow us to confirm the full year guidance. Let's now look at gas demand. In the first quarter, demand was up for the 9th consecutive quarter by almost 9% on a non-weather adjusted basis. Half of the overall improvement, or 1 BCM, was driven by power generation, where gas demand was supported by reduced imports from France, owing to the nuclear shutdown that highlighted, once again, the importance of gas capacity for the security of the system. In addition, power generation from hydroelectric and wind was lower during the quarter. This trend has continued in April. The increase in gas consumption of the industrial sector is mainly driven by the steel, mechanical, chemical, and paper segments, pointing to a continuing underlying recovery of the Italian industrial production. Residential demand was flat on a weather-adjusted basis. Gas injected into the system was up 15%, reflecting higher demand and lower gas withdrawals from storage relative to last year. Turning now to our results. EBIT in Q1 was 353 million euro, up 22 million euro or 6.6% over the same period of the prior year. The EBIT number reflects approximately 8 million euro increase of regulated revenues due to the yearly tariff update, controllable fixed cost reduction of 4 million euro, out of which circa 2 million euro are from the first result of our saving initiatives that are on track to reach the target of more than 10 million euro saving for the full year, set during our recent strategy presentation. Higher amortization in line with our asset profile evolution of about 10 million euro. In addition, it is worth flagging that these numbers contain higher storage revenues for 5 million euro for different time profile of tariffs compared to the prior year, which will be absorbed in the second quarter. The increase in transport revenues as a result of the higher transported gas, about 5 million euro. As a reminder, a small part of our revenues, up to plus or minus 9 million for the full year, is connected to gas volume that, as I previously said, have been very high in the first quarter 2017. Lower risk provision recorded in the first quarter of the year, about 3 million euro. Capital gain on sale of materials and reduction in costs caused by different phasing of spending, which we expect to normalize in the next quarter. Turning to net profit, the first quarter 2017 recorded an increase of 42 million euro from 2012 to 254 million euro. So 254 million euro. The increase was mainly driven by the previously commented increase in EBIT, lower net interest expenses of 19 million euro, thanks to the reduction of the cost of debt, driven by the liability management executed last year, new issuance executed in this first quarter, and lower average debt after the demerger of Italgas from 11.7 billion to 10.8 billion euro. Higher contribution from associates, which also reflects the positive contribution of GCA that was acquired at the end of 2016. Please remember that this was the last quarter in which the IGF transport business benefited from a WACC of 6.5%, which has been lowered from the beginning of the second quarter 2017 to 5.25% due to the last well-known regulatory review. In the end, higher taxes due to higher earning before tax, notwithstanding the reduction in the corporate income tax rate. The tax rate for the quarter was around 25%, in line with expectations. Cash flow from operations amounted to 917 million euro. This number includes 53 million euro of ordinary positive working capital and 90 million euro owing to net tax payments. 143 million euro from the balancing activities, offsetting the absorption that we saw in the last quarter of 2016, also in the context of a better supplied market. 259 million euro, mainly due to the time lag between the cash-in of tariff-related items which are attributable to past periods and not yet paid to the equalization fund. The reported cash flow from operations fully financed net investment of 355 million euro, including the further investment related to our participation in TAP of circa 50 million euro. Following the share buyback activity of 201 million euro, the reduction in net debt was 362 million euro. Our guidance for the full year of 11.5 billion euro of net debt is confirmed. We remind you that this assumes 0.3 billion of true-up on TAP financing and essentially neutral working capital, which is our expectation for the year as a whole. Cash flow from investments is 355 million euro due to the 183 million of net capex and 119 million of change in payables, mainly related to investment made in 2016. The capex plan in our core Italian portfolio is progressing well, thanks to our operational excellence in project management. These allow us to confirm the guidance of 1 billion euro capex for the full year. In addition, obviously we will have the full contribution of the equity call for TAP. So our total investment for the year is confirmed at 1.3 billion euro. And now let me give you an update on Snam's debt structure. As regards the capital market, in the first quarter, Snam raised an aggregate amount of 1.2 billion euro. At an average cash yield of 0.7%, well below our current average cost of debt, with an average maturity of 6.3 years, thus further extending the average life for medium to long-term debt. This includes the 5 years 400 million equity convertible bond recently issued by Snam, which is the second zero-coupon issuance in the last 6 months. As regards debt breakdown, the fixed rate portion is 85%, well above the 64% of year-end 2016 as a result of the fixed-rate bond issuances in the first quarter and the unwinding of a fixed-to-floating interest rate swap of 500 million euros. We confirm our guideline of three-quarter fixed floating debt for 2017. The maturity profile is well spread over time and our liquidity profile remains strong with 3.2 billion of undrawn committed credit lines. Our cost of debt averaged 2.2% in the first quarter 2017, already in line with our guidance, with some room to further upside thanks to the benefit of the action executed in the first 3 months of 2017 and possible treasury management optimization. And now let me give you some more color on the share buyback program and the recently issued convertible. In March, Snam issued a 5-year 400 million euro convertible at 0 coupon and 0 yield, driven by the following rationale. The convertible bond is a cheap source of financing with cash saving of circa 80 basis points versus an equivalent plain vanilla bond, although no P&L effect is visible for reasons related to the accounting treatment of the equity component of the instrument. Being entirely served by own treasury shares, the convertible bond is cash accretive for circa 20 million euro per year due to cash saving on financial charges on top of dividend saving on the underlying treasury shares. Effective conversion premium is over 50% based on dividend yield issuance. In addition, Snam was able to create value because the share buyback average purchase price was lower than the equity convertible reference share price. Moreover, the equity convertible has enabled Snam to tap a different source of funding. The success of the transaction confirmed the strong support of investors on Snam equity story. Thank you for your attention, and I will now be delighted to take any question you may have.
Thank you. If you'd like to ask a question at this time, please signal by pressing star 1 on your telephone keypad. If you're using a speakerphone, please make sure your mute function is turned off to allow your signal to reach our equipment. Again, ladies and gentlemen, please press star 1 to ask a question. We'll pause just for a moment to allow everyone to signal. We'll now take our first question from Harry Wyburd of Merrill Lynch. Please go ahead.
Hi, good afternoon, everybody. A couple of questions for me. Firstly, on the convertible bond, could you just clarify something you mentioned when you were on the slide there, that because of the equity or the accounting treatment of the equity component, that there's no P&L impact. So if I understand correctly, what you're saying is that you get a cash saving on interest, but there's actually no interest cost saving in the P&L. So could you just clarify that? And then secondly, and more generally, just your earnings guidance, I believe, in the long term, based on the CAGR that you gave at the full year results, assumes a 20 bip cut in the allowed return in 2019. So I just wondered if you could update us on what your outlook for that allowed return is, given that the spread between Italian BTPs and German bonds remains very wide, which should suggest a potential or possible upgrade in the allowed return. And what is the sensitivity of your net income if you, instead of assuming a 20 bip cut, actually had that being flat? Thank you.
Thanks for your question. As it regards to the convertible, what I meant is that effectively this is a cash zero coupon, but the P&L will show the cost of the instrument with a figurative 80 bips as if it was a traditional plain vanilla bond. That's the way from an accounting standpoint you will see the numbers, but the cost on a cash basis is zero. As it relates to the allowed return, nothing has changed versus what we said to the market at our strategy presentation. We have no element to take a different stance than what we said before. Spread were exactly where they are today, so we don't really have any additional implication to take from where we are today. And also, as we are getting closer to regulatory reviews, we don't want to guide the market towards adjustment that may be positive due to the simple counter risk premium spread.
Okay, I understand that. And just coming back on the first question there on the convertible, so there will be a P&L charge. What does that work out at as an effective interest cost on the bond?
As I said, it's 80 bips on 400 million. That's the nominal figurative number that you would see pro rata for the convert. Cost on a cash basis is going to be zero.
Okay, understood. Thank you.
Thank you. Our next question comes from Enrico Bartali of MainFirst. Please go ahead.
Hi, good afternoon. A couple of questions on my side as well. First of all, on operating costs, if I'm right, actually they were down compared to the first quarter last year by 19 million euros. Could you please elaborate a bit on the drivers of this cost reduction and on which part of this reduction can be sustainable and repeatable over the next quarters? A second question is related to the associate figure. If you could please give us the contribution from TGF, TAG, and Gas Connect to the figure. And finally, on the memorandum of understanding that you signed in Ukraine recently, could you provide us some details on the possible business development there? I don't know, if possible, some indication of the level of revenues that you think that can be achieved in that market, and if something similar can be replicated in other countries. Thank you very much.
Okay, so as it relates to cost, I think what is important is that out of the 4 million of reduction in controllable fixed costs that we had in the first quarter, about 3 million can be considered structural, of which 2, thanks to our cost-cutting initiatives that are part of the broader plan that we did present in March. The remainder of 1 million for the fixed controllable cost is connected to a different timing of spending, so we expect that to be reabsorbed during the rest of the year. Overall, we remain confident that we will hit a flat fixed controllable cost guidance for 2017, as we said it in the past. The second question was, I think, or the third was in relation to the MOU that we signed recently in relation to Ukraine. For us, that is a first step for a possible contract that involves Snam Global Solutions. So it's more related to possible engineering and project management services, but not to deployment of capital. We gave some indication of what we're trying to do with Snam Global Solutions, and that goes into that direction. Sorry, what was the third question?
No, it's related if this kind of opportunity in terms of business can be also replicated in other countries. And the last one was the breakdown of the 41 million of associates.
Yeah. As it relates to the last one, unfortunately, some of our associates haven't reported yet, and so we stick to the aggregated number of 41 million for the quarter. As it relates to future opportunities for Snam Global Solutions in other situations, yes, obviously we will keep looking for additional opportunities of this nature of asset-light services that we are trying to progress on.
Thank you.
Thank you. Our next question comes from Javier Suarez of Mediobanca. Please go ahead.
Hi, good afternoon to everyone. 2 or 3 questions on my side too. The first one is coming back on the slide number 13 on the total cost of the company that are down quite sizably. You had mentioned that 3 million euros are structural. I just wanted to have, if you can help us to understand what is behind the 4 million euros reduction in variable cost and then 5 million euros reduction in other costs. If you can help us to understand the reason for that and why that should be reverted through the year. Second question is on the working capital improvement. There has been some sizable improvement during the first quarter, and it could be conservative to consider that working capital effect by the year end could be zero, as you mentioned during your speech. And if so, which are the reasons are the things that could make working capital to contribute positively by the year end? And the third question is, during your presentation, you mentioned that the 2.2% cost of debt has some room for improvement. Can you help us to understand which is the room that you believe the company has to reduce the cost of debt through 2017? Many thanks.
Okay, so in terms of other costs, the variable reduction is mainly related to non-cash items that are related to evolution of gas inventory, and therefore we expect this to overall normalize during the course of the year. As I said, there were other cost reduction in terms of lower risk provision, lower depreciation, if you wish. I think there are elements which are structural. All the rest of it we expect to normalize as different phasing during the rest of the year. So I think that the combination of at least 10 million of cost reduction through our saving initiatives on one side and flat fixed controllable costs, I think it's which is confirmed from our prior guidance, is something that we are able to confirm today. When it comes to working capital improvement, it's basically related to a different time lag between when we receive money and when we give this to the fund, the equalization fund. So that was the effect that we got for the first quarter. We do expect this to normalize. It's a different way of looking at the 2 months that we need to pay as part of the additional tariff component to the equalization fund. So we do see this as a temporary effect, which will be by the year end effectively neutralized. When it comes to cost of debt, effectively the upside should come from a number of things. First, the full benefit of the actions that have been executed during the first quarter, so the emissions and the benefit of the unwinding of the derivative that we commented on. We also expect to have some benefit from an additional utilization of banking facilities that will, on one side, balance the mix fixed floating, but at the same time, given the terms that we have for our banking lines, will help us potentially to optimize our funding cost, as well as continuing benefit for last year actions in terms of liability management. The last point that is worth reminding is that, as you know, we do have a bond that is expiring in June. The coupon of that bond is about our average, so obviously that will mathematically further give some small improvement.
Thank you.
Our next question, ladies and gentlemen, comes from Stefano Gambrini of Equita SIM. Please go ahead.
Good afternoon, everybody. A few questions, if I may. First of all, regarding the TAP situation, could you update us regarding the last events on the TAP, and if there are some significant delays on CapEx due to the problems in South Italy? The second, there were some rumors on the press that the Italian government was interested in the Poseidon EG project that could even enter in the national energy strategy. Could be something that is interesting for you, and these rumors reported of a 6 billion euro project, if this is something that in your view is real. Last thing regarding this guidance on OPEX, fixed accountable cost for the full year, with a 10 million euros reduction of cost, how this could be fixed in real terms? So what is the inflation that you expected during 17? Thanks.
Thanks, Stefano. As it relates to TAP, and TAP is a strategic project that benefits Italy and Europe and is invisible once it's completed, with very limited impact from an environmental perspective. The first tranche of work, which involved preparing the ground for the activities on the micro tunnel, has been completed. All the olive trees that have been moved will be planted in the same position after the underground has been laid. In our plan, TAP is assumed to come into operation in 2020, and there is no expectation of delay as of now. And the expected contribution, just as a reminder to everybody, to our net income in 2021 is around 50 million euro. 50 million euro. So nothing has changed. What should have been done has been done, and we are on track. When it comes to Poseidon, we don't have elements to comment on the value of project in which we are not involved as a first reaction. Consider that we evaluate any initiative that may arise, in particular if it involves Italian gas network, with the investment criteria that we did present our strategy presentation, i.e. we target risk-adjusted returns that are at least in line with our regulated Italian activities. We are maintaining our credit rating is a firm gate for us. And we also focus on opportunities that allow us to play an industrial role and that support long-term growth. On OPEX, I think overall the inflation, if we also consider labor cost, is probably around 1.5%, roughly speaking. So that maybe help you to combine the guidance we gave on total cost of at least 10 million saving with the expectation of flat in real terms fixed controllable cost.
Okay, it's clear. Many thanks.
Thank you. Our next question, ladies and gentlemen, comes from Oliver van Dosseleri of Exane. Please go ahead.
Yes, good afternoon, everyone, and thank you very much for for taking my questions. I had four. The first one was relating to the fact that the Greek government seems to have come to an agreement now with its creditors that would include again some privatizations, and I think the potential sale of the gas transport network is part of that, and also the idea seems to be that it should be sold to a European actor which actually has transport capabilities. So I guess you would actually quite naturally come into the picture there in terms of a potential candidate. Is that something, an asset that you could actually be interested in? I know that we know that you have looked at it in the past. A second one is on other new investment opportunities, but domestically, you had said that the full year results that maybe in the future there could be some new thing that could come up in terms of new LNG or further investment in the Adriatic backbone or in Sardinia. I was wondering, I know that the full year results were very recent, so I don't know if there's been any further or new discussion that would have started on that. A third question is on the convertible bonds and on the share buyback. I think that initially the idea of the share buyback was that it was going to be used as a tool to optimize your capital structure. Now, if that will actually be used as a backup to a convertible, if we would take actually the assumption that it would be converted in the end, would you see scope for Snam now to decide to raise its share buyback program again? And then the last question is on the tax rate. I think you mentioned a 25% tax rate in Q1. That seemed actually a bit low to me relative to what I would have expected for the full year. So if you could confirm what your full year expectations are for tax rate for 2017 and maybe for the years ahead. Thank you.
Thanks, Oliver. As it comes to Greece, first we don't usually comment any M&A rumor speculation. And in addition, the new privatization process has not yet been defined or decided, so there's a lot of rumors and expectations. But when the picture will be clear, we will take a look at what is the situation and decide what will be our possible interest in the tender. In any case, we will examine this transaction as every other transaction, applying a strict financial discipline and only pursuing an industrial role rather than a financial role. As it comes to Italian additional growth opportunities, as we flagged in our strategy presentation, nothing has changed in that regard. Those that we highlighted remain those that we may consider or that we would be interested to consider should they be possible and feasible, but we don't have much to report. When it comes to the share buyback, you will remember that our latest shareholder meeting, we extended the maturity of our buyback up to October 2018 without changing the overall size. We also indicatively gave the signal at the strategy presentation that we were currently planning to only complete up to two-thirds of it and not all of it. Nothing has changed in our mind. As we said, yes, the buyback is a good financial flexibility tool to optimize our capital structure, but we have also been very savvy in running the buyback algorithm when our share and implied premium to RAB was overall value accretive in our view. And that principle remain valid. When it comes to tax rate, the first quarter is typically a lower tax rate quarter. So the 25% that we had in the first quarter of this year should be compared with 27% last year. So of course we had the benefit of the lower IRES, but we had some impact of lower benefit from ACE. Overall, in terms of full year guidance, we expect tax rate to be in the 26 to 27% area.
Okay, that's great. Thank you very much for that.
Thank you. Our next question comes from Anna Maria Scaglia of Morgan Stanley. Please go ahead.
Hi, good afternoon. Just a very quick question from me. I was wondering if you have had any update on the timing of the review and whether now is it clear to you whether the new regulatory year will be 2019? Thank you.
Very quick answer, no. We have no update. Sorry.
Thank you. As there are no further questions, I'd like to turn the call back over to the speakers for any closing or additional remarks.
Thank you, everybody, for your time and availability. Good afternoon.
That will conclude today's conference call. Thank you for your participation, ladies and gentlemen. You may now disconnect.